Today, I'm pleased to welcome Steve Saretsky, a real estate aficionado and a Vancouver-based realtor. Steve is an avid student of macroeconomics and credit cycles. He's also the author behind one of Vancouver's most popular real estate blogs called the Saretsky Report. He hosts his own podcast show and is on all your favorite social media channels, including 30,000 subscribers on YouTube and 42,000 followers on Twitter. You can also find Steve making regular appearances not only on Coastal Front, but of course on BNN Bloomberg, CBC, and Breakfast Television. Steve's dedication to stats, policies, and the financial landscape has allowed him to build a very successful business, and he's ranked as one of the top 1% realtors in Greater Vancouver. He also provides services to investment advisors, financial institutions, policymakers, and real estate developers. In addition, he claims to be a washed-up hockey player just like me and a coffee connoisseur. On today's show, we will be diving into Vancouver's current housing situation, talking about policy, and let Steve give us his expert opinion on where he thinks things are headed next. Steve, thanks for being at Coastal Front today.
Yeah, it's quite the intro. That's hard to top. I'm a lot of pressure now.
Well, thanks for coming in. Let's dive right into it. We talked about this earlier in the week when we did our pre-podcast call, that new listings in Canada have hit a 20-year low, as well as Vancouver is now seeing a pretty big rise in vacancies amongst office real estate. I don't know if we want to talk about that, but let's go to this amazing stat, 20-year low across Canada as far as listings are available. Can you tell us, paint a picture for us, why is that happening right now? And what does that mean for the real estate market?
Yeah, it's interesting when you really unpack it, because coming into 2023, the narrative was interest rates have gone up. The Bank of Canada has raised rates over 400 basis points in less than a year. Mortgage rates go from 2 to 5. Surely there's going to be a lot of financial stress. Households that are highly levered in Canada, we're going to see a lot of listings coming to market. Foreclosures are going to increase, and we're going to have an oversupply of listings in inventory, which is going to lead to a sharp price correction. That was kind of the narrative, and I think logically it makes sense. And so far, to start the year nationally, you're right. Across the country, you have a 20-year low in new listings hitting the MLS system. Here in Greater Vancouver, where I operate, you had a 23-year low, not only for the month of February, but for March as well. We just got that data that came out. So I think the biggest thing that we're seeing is there's a couple reasons, I think. Just conversing with clients. First of all, in order to list your property, you typically want to know where you're going to go. And so if there's nothing to buy, you're typically saying, well, why would I list my house? Where am I going to go? Okay. So that's number one. I think number two, the volatility in markets. It's been a relatively soft market over the last 9-10 months. And homeowners are going, well, I don't like the price that I'm going to get for my place. I think that's an element of it. I think that you can continue to unpack it. I think there's an element that it is tough for some people to move up, because the reality is you're getting stress tested on your mortgage rate at 7%, which reduces your ability to borrow money. And so I think all these factors are playing a part. And so, if you kind of unpack it, you have in Canada, if you have a fixed rate mortgage, you typically have 120 days to port it to a new property. So you got to find a property, close on it within 120 days. And so when there's very low inventory on the market, you're going, okay, well, if I sell my property right now and I have nowhere to go, I basically have 2 or 3 months to find a place. And then I got another 30 days to then close on it to be able to port my mortgage of 1.9%. Otherwise, I lose that rate and I got to sign on the whole term. Right. At 4.8, 4.9%. Mm-hmm. So I think I think all of the above are contributing right now to the lack of listings coming to market.
Okay. I've had an observation over my 25-year career in the professional world, but also growing up with a dad who did what you do today. Like my dad was a realtor, and my grandfather and my uncle also owned, I don't know if you remember the brand Block Brothers from years ago, but they owned a couple of Block Brother branches on Vancouver Island. And of course, we've gone through many economic cycles in BC, and particular one I remember as a kid was the sort of economic downturn of the early 80s. And you went from, a very high inflation environment, far higher than we're at right now, but it's sort of a very similar spin to what we're seeing. And my observation has been that when you have a major real estate correction about to happen, typically what happens at the very beginning is you get a big peak, right? And this happens in the stock market as well. So you've got markets bumping along, and then it has this big rise up in pricing. And then it sort of peaks. And what happens on volumes is they start to drop right away. And that's kind of like your first sign. And the reason they drop is because you've got sellers that are up here and buyers are going, I'm not going to pay that anymore. I'm going to wait. Now they may, because they see prices coming down, maybe because they can't afford, because interest rates have gone up in that context. And so you have this like gap between where sellers are feeling they should be and where buyers feel they should be. And so then it's just a matter of a test of time, right? Like who's going to capitulate first? And typically people need to sell more desperately than they need to buy. That's general rule of thumb. I mean, people tend to be able to, wait wherever they're at. If they need to upgrade, they can wait a little longer. But people who need to sell for divorce, estate, if someone passes away, like you're not going to keep grandma's house unoccupied, especially with these, these empty homes taxes and whatnot. And so it's all you need is a matter of a little bit of time and a few people to capitulate. And then you get a lower price reference, and then that starts to kick in. And now all of a sudden there's a reset on valuations, and people start to go, and as time goes by, people start going, okay, 3 months ago, yeah, I could accept the fact that my house maybe I was going to wait and see if my house price could go back up. But now it's been 6 months. Now it's been 9 months. I don't think my price value is going back up. I think that we hit the peak. It's time to sell now. And then what you have is a flooding of people coming in. And that's why I almost wonder, we're getting into the spring right now. And I almost wonder, coming into the summer of 2023, if we may see a flood of inventory come in the market. You also, just generally speaking, when you have pendulums move from one end of the spectrum, they always sort of swing back. So if we're at 23-year lows of inventory, I kind of question, well, maybe we're going to be heading towards 23-year highs of inventory by the summertime. Especially right now with rates settling out where they're at, like no one's expecting rates to be cut, but also no one's expecting rates to go higher. So a lot of potential buyers who are going to enter in the market or kind of wondering about what they're going to do with their mortgages are going to go, well, the rates aren't moving, so I'm going to have to accept where we are now for the foreseeable future. So what are your thoughts on some of those comments?
I mean, I think you're correct. I mean, I think that, real estate is historically very sticky. The bid-ask spread can kind of blow out, right?
Yeah.
I think we definitely saw some of that. I think in the early days, especially last summer, the sentiment was bad. Bank of Canada was raising rates 100 basis points at a time. Sellers were simply too high. Buyers were throwing low balls out there and trying to get that price down. Where we saw some of the sellers, I suppose, capitulating was in a lot of like estate sales, people that needed to sell.
Right.
Again, could be divorces, relocations. So we saw those houses basically clear, and they obviously cleared at lower prices. I think, peak to trough, you could see 20% discounts in suburban markets in a span of really 3, 4, 5, 6 months. Mm-hmm. So it was a pretty sharp correction. Right now, you've got this issue right now where you've got incredibly tight inventory. And so to me, but I think it could be, operating in the market back, we saw this the most recent time was in 2016. Mm-hmm. So the market had this sort of blow off top in 2016 here. And we had sellers that kind of retested the market in 2017 because they couldn't get their price in 2016. They tried again in 2017. And the market had a slight resurgence into 2017 and said, okay, maybe that's the worst. And then in 2018, it continued to sort of roll over. But we did see a lot of houses that they would try in 16, they didn't get their price. They tried again in 17, didn't quite get their price. They tried again in 18, didn't quite get the price. They changed the realtor towards the end of 2018, and they finally sold it pretty much at the lows.
Right.
But it was really like a 2.5 year process for some of these people to really accept the price discovery in the market.
Yeah.
So I think that's definitely a possible route that we could go. We need more inventory. I agree to your point. It's not natural to have a 23-year low in listings. So at some point you're going to have these people testing the market. It's just a matter of when and how much. We've been saying to a lot of our clients, like, I don't have a crystal ball of where we're going to be 12 months from now. All I can say is in the next 2 to 3 months, we have inventory levels that are the lowest standing inventory. It's not now we're talking not just about new listing, but standing inventory. Standing inventory levels as of the end of March are the lowest we have on record going back to 2004.
It's incredible.
Which, you start adjusting for population, the growth in the housing stock since 2004. So between now and the next 2-3 months, not a whole lot's going to change because you need inventory to go from record lows to basically even healthy balance levels to start getting some normalization.
Right.
And then it's going to take time. Like basically you have to have a period of listings outpacing sales in order to build those inventory levels.
That's a good point.
To a point where then you get sellers that have to basically start reducing pricing.
Yeah.
And so right now, sellers surprisingly are in the driver's seat just because of this lack of new listings coming to market. So I would say, there's talk in the media, and it's true. We're seeing the multiple offers. We're seeing some bidding wars coming back. We're seeing sellers setting offer dates. It's not because you have this like insatiable demand where people are like, I got to get into the housing market like we saw during the pandemic. We saw during 2015, 2016.
Yeah.
It's just there's literally no inventory. And the people that need to transact, AKA young families.
Yeah.
They have a kid, their wife's pregnant with another one.
Yeah.
They have to upsize.
Right. Yeah. There is truth to that there's a certain segment of the buying population that also have to buy. They have to or upgrade or expand in size.
Coming here for a job, they have to expand.
Right. Yeah.
Parents are, getting so old that they need to get rid of the stairs and downsize. So there are elements that of people that need to transact, and unfortunately, they're transacting at a time when there's no inventory.
Yeah.
And so
are you seeing people sitting on real estate that maybe they were intending to develop or something, and they're going, hey, you know what? Like no inventory. I'm just going to put a high offer out there and just put a price out there and see if someone takes it.
In terms of
like potentially someone who's owning a rental property that they were going to hold on to, but they're looking at the price. They maybe held it for the last 5 years and like, wow, there's no inventory. I might as well see what I can get for this place. So you've seen that kind of activity?
I literally had one this month.
Okay. And I'm talking about not just putting it for sale, but putting out a price that's kind of like, hey, you know what? If there's so little inventory, if someone's willing to pay me this premium, I'll sell it. Otherwise, I'll just keep it. But they're not looking to they're not desperate to sell. They're more like testing the market just because there's nothing else available. Yeah,
I'll give you a story.
Yeah.
Past client calls me up, says, hey, I've got this 1-bedroom condo in Vancouver. Can you run the valuation and help me sell it? So, I said, hey, I think you should probably list this thing. I think it's worth 550, 560. I think you should list it at 559, maybe on the high side, 569. He says, okay, well, no, I actually want to go on at 599. And if I don't get basically at that price, I will rent it out. And I said, I literally said to him, I says, there's no comparable in the building that suggests that. And the market isn't, in my opinion, wasn't that strong. So I actually politely turned down the listing, which is something I rarely do. But he says, please work with me, past client. So anyways, we came to an agreement. I said, okay, listen, we'll give it a couple weeks. If you get what you get. So we ended up listing it at his price and going into multiple offers, selling above the asking price.
You got to be kidding me.
Yeah.
Sold above the asking.
And then I actually end up looking like the idiot because I'm saying, I said I wasn't even going to list this. Yeah. I think you're out to lunch, but there's literally nothing available. And so I think it's hard to figure out price discovery right now.
Yeah.
So it's a very funny market. We went from nothing moving to all of a sudden, if you have a listing, you're the only one on the block.
Yeah.
And people are paying, I think, quite elevated prices considering that mortgage rates are still at 5%.
Right.
You got talks about a looming recession. You've got some banking issues in the US. So you've got all these macro headwinds.
Yeah. But
people are seemingly unfocused on that right now and just saying, I got to buy a property.
Yeah. Yeah. It's incredible.
It's very, very fascinating.
Yeah, that is. Look, there's several factors that affect real estate prices from, population growth, which kind of applies to the demand side of the equation, cost of capital, which really affects supply side. I mean, of course, things like ownership laws, these latest rules we have around, being able to automatically convert a single family home into a fourplex, introducing house flipping taxes. Like there's a lot of factors, but they all kind of like end up leaning towards supply and demand, right? Like, and that's, I'm a very much a free market economist type. I'm in favor of free market sort of enterprise solutions. And my view is like, if we have a housing sort of affordability issue, I think the easiest solution is just create more supply. It'll bring prices down. Do you have an opinion on that kind of very simplistic view of like, there's demand, create more supply, prices come down?
Yeah, I mean, I have a lot of thoughts on that. I think that, first and foremost, if we look at what we've done over the last 5 years, you've brought in empty homes tax, a BC speculation tax. You've increased the property transfer tax. You created a school luxury tax. You created a foreign buyer tax. You then actually increased the foreign buyer tax. Then you brought in a mortgage stress test. Then you brought in a foreign buyer ban. And housing hasn't got any more affordable,
Right.
despite all that. So it's actually quite fascinating. I think the biggest issues, or reasons I think for higher prices is the financialization of housing. You drop interest rates to zero for a decade, and you open up the floodgates to a lot of foreign capital coming into the market.
I would argue 2 decades, actually. We've had generally trending 20 years worth of declining cost of capital.
Exactly. And then you have it's been really a 30-year bull market in housing.
It has been. It's amazing.
And every time that housing gets tested, the government seemingly steps in to support it. Yeah. And I think it's actually created a lot of bad behavior.
Yeah.
It's basically allowed people to believe that housing can never go down, and so you create this like speculative, it feeds on itself. Yeah. Right. I mean, you remember,
Steve, if just to interrupt for a sec, but if you look at some of those things you just implemented, or you just talked about, like speculation tax, foreign home buyer tax, foreign home buyer ban, these all those do is address the demand side. Right. They're trying to like minimize demand, but like we have simple population growth through like immigration and candidly like urbanization of our society. I mean, like just globally, people are leaving small communities, rural environments, and coming to cities. I mean, you don't really hear people talking about home affordability in like my hometown of Port Alberni, right? Yeah. Or in like, in I don't know, like in my wife's family's from Williams Lake. Like you never hear anybody going, "Oh, housing is just way too unaffordable in those towns," right? You live in those towns, you either have a gainfully paid job at the mill, and then you can buy a house. I don't think you hear those people complain about it. It's here in Metro Vancouver. It's in places like Toronto and Calgary, I think Metro Vancouver in particular, and even more so in Vancouver proper, because there's a lot of people, as Bob Rennie had pointed out, this idea that you have the right to be able to buy a white picket fence sort of single family home in Vancouver. I mean, like that's not an option for everybody anymore. Like if you go to Paris or London or Tokyo, those aren't options anymore. They were gone like 300, 400 years ago, right? So when I look at this, I just go back to like the supply side to me, which I think has been a fail of mostly municipal government. And that's what David Eby's trying to fix here with this idea of being able to just like force these municipalities to start approving projects. I mean, I think that's been the biggest problem in Vancouver is that developers haven't been able to build as quickly as they'd like to. And it's not like they don't have the capital or the desire. It's just like you go to City Hall to get approval for a project, it takes forever. And then there's that all gets added into the cost of the home. What are your thoughts on that?
I mean, I think it's entirely true. I think that the bureaucracy to try to get a permit approved, the length that takes, those are just holding costs that the developer has to accrue, and then ultimately the taxes, right? I mean, I was chatting with a developer the other day. To build purpose-built rental buildings here, it's about 25% of the cost is taxes. So that ultimately has to feed through into your pro forma, and what you can actually build. And so, I think that unfortunately, I do think government is certainly to blame. I think that they do need to step back. I think David Eby's policy, I'm sure we can get into that, but I actually think it's grossly needed. I think.
Well, let's get into it. That's actually my very next question, which is I think the one we're talking about here is this idea of having a province-wide zoning change to allow any single family residence to have an immediate approval to turn it into a 4-unit single family lot. Is that what we're talking about?
Yeah.
Okay.
Correct. Yeah.
And you support this concept?
Yeah, I do. I think regardless of what your politics are with David Eby, love him, hate him, I think he is trying to leave his mark. And I think that the one thing I see, as a realtor day to day with clientele is you've got this millennial base that is now growing up. They're starting to have families. And the biggest issue I see is most families are stuck with 2 choices. They can either go into a 2-bedroom condo or they end up into a detached house. There doesn't seem to be a lot of that missing middle product. There's not a lot of duplexes. We're starting to build them. There's not really a lot of townhouses. And so you're stuck with the choice of, okay, I can either raise a family in a 2-bedroom condo, which can be quite uncomfortable. It's not what we're used to in North America. Or you go to the detached house. With the detached house in the city of Vancouver, your starting point on the east side is about 1.8 for something decent.
Yeah, sure.
For something livable.
Or you go way out to like almost Chilliwack. I mean,
you got to go far
east,
out.
at least Langley for sure.
I mean, even Langley, you're talking for a very modest detached house, you're talking 1.4 million.
Right.
So it doesn't really get a whole lot cheaper. So
yeah.
we do have this missing middle issue.
Mm-hmm.
I believe the stat is close to 50% of the residential land in the city of Vancouver is actually zoned for single family, which doesn't make a whole lot of sense when you say your starting point just for the piece of dirt. I give you the piece of dirt for it's $1.7 million just for the dirt. And that's basically a tear down house. So that's not affordable for a lot of people. So I think we do need a lot more of this density. Now, I know a lot of people that have had a single family house. You lived on the west side. You've been there for 30 years. You probably don't want a bunch of, triplexes going up next to you. But I think the reality is if you want to keep young families and have people having children,
yeah.
You think you start to wonder why people in Vancouver don't have kids anymore. It's
if
you don't have housing to grow a family, I mean, it's going to discourage you from obviously having a family.
Yeah, sure. Well, if you were to put on your critical hat though and say, okay, well, let's be devil's advocate, because anytime government tends to throw sweeping policy like this, where it's just like carte blanche, it doesn't matter where your single family home is, you got an immediate opportunity to convert it to a 4-plex with no holdbacks from the municipal government. There's got to be some impact to that, right? Like there's always unintended consequences. Do you have any thoughts on what those might be?
I mean, in the very near term, it's a land lift for the, so people that are sitting on single family homes, your land value is going to increase as the density increases. There's no doubt about that. I think over a long enough period, let's call it 5 to 7 years, I think the young families are actually going to benefit from this policy.
Yeah.
Because I think you will get quite a bit of construction out of it.
Yeah.
There's a policy, and New Zealand was the first to launch it. If you look at a lot of their data, you can see that building units under construction has mooned.
Right.
And then it is bringing pricing down. Mm-hmm. It's bringing rents down as well. And so I think it's going to take some time, but I think that, like I said, in the near term, it's going to benefit the landholders, and over the long 5 to 7 years, it's going to benefit young families. I can tell you, as I'm actually working on some of these projects, Calgary has it. Calgary already has any single family house. A lot of them are already allow you to build duplexes, 4-plexes, infill housing.
Yeah.
In an area that is already, I would say, less land constrained than Vancouver.
Mm-hmm.
So they're much more open about their zoning over there. And I can tell you that it's a very, very popular housing option for young families, because even families in Calgary, for example, they go, well, I can get a 1950s bungalow for, $700,000 in the inner city, but I'd rather pay $800,000 and get a brand new, basically duplex.
Yeah, sure.
Because it's brand new. I get all the modern finishings. I don't have to worry about an old, 80-year-old house.
Well, on that note, I think that's one of my observations, one of my observations as well, is that a lot of young people aren't prepared to do what at least my folks did, which was to buy an older rundown house and like literally be willing to live in that and maybe upgrade over the years, but you're kind of jumping from one sort of beaten up 40, 50-year-old home to the next, and you kind of work your way till, maybe your first home's 40 years old, the second home's 20 years old, your third home's 10. And then, by the time you're in your 50s or 60s, you're building new for the first time. It seems like a lot of young people don't want to do that. They want everything new right from the start. Yeah. And they have to, you got to pay a premium for that. It's like buying a new pair of shoes versus an old used pair of shoes. Do you have any observation or view on that?
Yeah, I think that's definitely true. Like, just like with the clientele that we work with, you can tell like people just, I don't know if it's just changing the time. People are busy. It's a lot going on, and people just, I don't think it's like that trade. It's almost like the same reason why do people not go into trades anymore?
Yeah,
like there's a shortage of trades. It's not like sexy. Like nobody wants to be a plumber and electrician anymore. Yeah. So I feel like, and it's the same thing. Like I don't think people are equipped with the tools like maybe our parents were growing up of going and fixing your old house. Yeah. It's like you call the plumber when you have an issue. You call the electrician. You call people. You call the handyman to come do some. So yeah, the younger generation I think is much more inclined to go into newer product. They want set it and forget it. 10-year home warranty. Mm-hmm. Don't have to worry about it. So yeah.
But that's important to recognize. Like when I hear people complain about, well, I can't afford to get in the real estate market, I'm like, well, what do you want to buy? Because like I know there's plenty of condos, for example, over in kind of like East Vancouver on the other side of like, Canby Bridge that are smaller. They're 60-year-old buildings. They're kind of run down. You could afford to probably move into one of those places versus buying a brand new condo built in, downtown Vancouver.
I think it definitely, you can't sit here and I'm trying to justify Vancouver prices, obviously, but I think at the same time you do have to put like a little bit into context. Like I had, you chatted about it earlier about everybody wanting the white picket fence. I had someone reach out, a doctor, let's put it that way, a high income doctor, saying, I can't. Even Vancouver is so ridiculous. Even I can't afford a detached house on the west side of Vancouver. And I said, well, yeah, you and everybody else, you're competing not with local incomes, you're competing with global money.
Yeah.
To buy you're saying you want to buy the best piece of dirt in all of Vancouver on the west side. You want a detached house. Those are in finite supply.
Right. Yeah.
So as a doctor, you might not be able to afford that on your salary, even though it's a good salary.
Yeah.
The reality is if you want your detached house, you might have to go to Port Moody. You might have to go to Coquitlam or South Surrey.
Yeah. Okay, Steve, I want to jump to home ownership and how rising interest rates obviously affect, the cost to purchase. One of the stats that Statistics Canada came out with recently, which was amazing, is that 50% of Vancouver owned households are mortgage free. And I can't remember if it was you on Twitter or somebody who posted this infographic that showed, especially in areas, wealthier areas like Westside Vancouver, it's upwards of like 70% of these homes have no mortgages. So in those circumstances, then clearly these people are not impacted by rising interest rates. At least in that context, they might be with their pensions or something, their investments. Do you think that having such a high ownership of clear title homes is also impacting this market?
I think it's definitely impacting some of like the new listing side of it. Again, the discussion around, people are going to be stressed and foreclosing. And again, if you, it's a staggering statistic. Keep in mind that it only includes primary residence. So I tend to find that, while your primary residence might be free and clear, you're typically taking some leverage on an investment condo. And I think that's, if we're ever going to see a dumping of listings coming to market, I think you're going to see it first and foremost in the condo market.
Okay.
Because that's where the investors play.
Yeah.
That's where the leverage is. And typically, and I've had these conversations this year over the last 12 months, is a lot of investors are also inclined to go variable rate mortgages because it provides the liquidity. So, let's say you take on a variable rate mortgage, you hold this condo for 3 years, market goes up, you see it's a bull market, you're like, I'm going to dump this thing, make a quick couple $100,000, I'm good, I'm out.
Yeah.
So you want to be able to break that mortgage pretty much at any time. So a lot of investors will go with variable mortgages. So what we've seen is rates going up, putting pressure on it. And because of government restrictions on how much you can raise rents, we're seeing the pressure. We're actually seeing, I think, more investors right now actually cleaning up their balance sheet, not
Yeah.
necessarily adding to the portfolio. So everybody was adding to the portfolio during the pandemic. Everybody's like, I got to get one more condo, one more pre-sale. And now we're seeing, okay, I got 3 condos, let's sell one.
Right.
Let's clear up one because I've got 3 variable rate mortgages, and I went from positive cash flow $300 a month to all of a sudden I'm losing $500 a month, and I can't get rid of the tenant,
Yeah.
and I can't raise the rent more than 2%. So what do I do? And so these are really tough conversations.
Yeah.
Because
to sell.
Yeah, to sell.
Yeah. Just sell it because
That-
yeah. Does that impact a price if someone's trying to sell a condo and they've got a renter in there who's knows all the rental rules and they're month to month and
it's tough. So I'll give you this example. It's like,
I guess if you're a buyer, sorry, I was just say if you're the buyer and you're buying it for your own principal residence, then you're okay. You just have to factor that in 2 months.
exactly, but you're shrinking your buyer pool.
Yeah.
Right. So you go to
Right.
let's say you've got a 1-bedroom condo in downtown Vancouver. Market rent is $2,400 a month right now, and you've got a tenant in there because you put them in 3-4 years ago, and
Yeah.
you haven't raised the rent because you're a nice guy.
Yeah.
And the rent is $1,800 a month.
Right.
You've basically eliminated the investor pool
Completely.
because the investor.
Why would they pay?
Yeah.
They'd have to get a deep discount on the price to offset the below market rent.
Exactly, and there's no legal way to get them out unless they agree to mutually end the tenancy. And does the tenant want to mutually agree to end it, knowing that the market rent is $600 a month higher?
Yeah.
So you tend to lose a lot of investors. So now your buyer pool shrinks, and you have to basically hope to sell to an end user who's going to give notice to the tenant and legally get rid of them.
Yeah.
So that's the issue.
This report I have here, this is came out in January. I don't know if you ever read this. Is the CMHC publishes it once a year. It's the rental market report. And so this one is for Vancouver. What's really interesting is for Vancouver proper, PurposeBuilt Rental Market. Now this is as of the end of December of 2022. The vacancy rate for purpose-built rentals was 0.9%, like effectively almost zero. The average rent was just over $2,000 a month. And for condominium apartment rentals, the vacancy rate was 2.2%. And the average two-bedroom rental was $2,500. It's amazing. But the part that I found most fascinating about this was this statistic here. Asking rents for vacant units are now on average 43% higher than those paid for occupied units. 43%. So this BC NDP government, who thinks they're doing everybody a favor or the renters out there, by capping rental increases by 2%, is actually skewing the market, because basically you have this active rental pool of renters that aren't seeing their rents go up by more than 2%. But as soon as somebody leaves and that landlord goes to relist, they're having to think, okay, I got to jack up my rent, not to current market, but to offset the fact that I've got inflation at 7%, but I can only raise by 2%. So that's a drop of 5% per year. And if I think my average tenant's going to be in my place for, say, 3 years, that's an extra 15%. So if rents are, for simple math, if rents are at $1,000, I should actually make my rent like $1,150 now, right? Or $1,500 now. So it's amazing. Again, that stat is that the asking rent for vacant units are on average 43% higher than those that are occupied. What are your thoughts on that one?
I think that purpose-built rentals are still the best deal going for anyone in Vancouver that's a tenant, because as soon as you get in there, you cannot get kicked out.
Right.
You're basically, the way the tenancy laws are written, unless you really screw something up, you're in there. Yeah. And the increase is, if you're allowed to raise rents 2% a year, historically, I mean, they just don't keep up with the actual rate of inflation. And so people aren't incentivized to leave their purpose-built rentals. And so I still think it's the best deal going. Now, what I will say is, by doing that, ironically, while they are well-intentioned trying to protect the tenants, it's also ultimately throttling supply. If you're a developer that's saying,
why would you build?
Why would you build?
Why would you build a rent? What is it called?
Purpose-built rental.
Purpose-built rental. Like, it's
Exactly.
kind of crazy, actually.
It is crazy.
And then so what's happening now is the BC government's coming out with these things. Like I read that they're going to offer loans to builders to build purpose-built rental buildings that are really, like, I think there's zero interest or something, as long as they keep them rented for 5 years, something like that. I'm not really sure.
Yeah, I can get into that.
What was that about?
Okay, so that one the BC government was talking about was basement suites. So they want to legalize basement suites in all single-family detached houses, and so they'll say, hey, you have a basement, you have a home, you want to add a basement suite, we will grant you up to $40,000 and make it interest-free. And I think that I believe, don't quote me on this, I believe they wipe out half of it, so you only have to pay back $20,000, so long as you agree to rent out that basement suite below market.
That's what it was.
For 5 years.
Yeah.
Now, again, I don't know what happens after 5 years, because given the current guidelines, you can't just arbitrarily raise the rents and kick them out.
Yeah.
Now, back to the purpose-built rental side. The one thing the Canadian federal government has done a good job through CMHC is their CMHC has very attractive rental financing for these developers. They're basically financing the construction now, insanely cheap interest rates, and they're allowing developers to do up to 40-year amortizations at very favorable interest rates, below market interest rates.
Wow.
So this is actually the only reason why you're seeing, I would say, a boom in rental development in Vancouver and in other parts.
But that's just taxpayers now carrying that bill.
Essentially, yes.
Right? I mean, it's the federal government. It's not their money. It's us as Canadian taxpayers.
Yeah.
So if we're going to start floating that, that's just going to add to our tax burden.
Correct. Yeah. So, but I mean, that's the only way to make these rental projects feasible. And that's the only incentive that these developers have, because they're saying, well, if I can only raise rents 2% and my pro forma doesn't check out, the only way they're able to do that is say, your construction financing is dirt cheap, next to nil, and we're going to give you extremely favorable financing.
Yeah. Well, there's another effect that happens when you have strict rental controls, like we're now seeing in BC, that they have in places like New York City, which is buildings and units that just become very decrepit. I mean, if I'm a landlord and inflation is again at 7%, and I can only increase my rent by 2%, so I'm losing 5% a year in real dollars on my rental pool, on my rental income, then why would I bother upgrading the unit? Right?
Correct.
Like I might as well just let the roof kind of go. I'll let the paint go. The appliances, we'll let them just go.
Yeah. So our former mayor, Kennedy Stewart, who's obviously now not in power, he had proposed in the previous election where he got voted out, he was proposing rent freeze turnovers on rents. So basically saying, hey, you had a tenant in there. Market rent is again $2,400. You had them in there at $1,800. They left because they got a new job in Toronto. You have to refill that vacancy at $1,800.
Right.
You can't go back to market and put it at 24. And so under that circumstance, who's going to?
I mean, that's absolutely nuts. I mean, that Jean Swanson was trying to do that too, and she's gone as well now. But
I think the city of Burnaby had also talked about something along those lines too. So, but it's concerning that the conversation's even there.
Yeah.
But this is kind of where a lot of our politics, I think, are ultimately creating a lot of the problems that we have today, or policy decisions that we made 5, 10, 15 years ago.
Yeah.
And continue to make.
I mean, I like what David Eby's doing with respect to kind of bringing down the hammer on these municipal governments, because to me, that's who's failed more than anybody else. In my opinion, the federal government really has no play on residential real estate. Provincially, they can if they want to implement these kind of goofy taxes and rules. But ultimately, it comes down to like the municipal government. And when I've also talked to developers, they've told me over the last couple of years that they're getting out of Vancouver. Not only is the cost of dirt so expensive and the approval process is so long, and it's just so uncertain, like there's so much risk because it takes so long, when they can go to North Vancouver, right? Or they can go to Burnaby, or they can go to places like Edmonton, which is like really fast turnover. And as Chip Wilson, when he was on my show, I love the saying he had, which is capital goes to the place it's most loved. right? And if capital is not very loved here in Vancouver, why not send it down to Seattle or send it over to Edmonton? And it does move that quickly.
Yeah, I think there's a definitely a misconception, around. I mean, developers have always been villainized throughout time, but I think there's a misperception that they make tons and tons of money. Like the profit margins are mad. The profit margins are actually razor thin.
Yeah.
Yes, they're making lots of money because when you take fees off of $100 million project, obviously it starts to pencil pretty good. But the profit margins are actually pretty tight. So when you start seeing cost of construction going up, and then your cost of financing going up, and you pre-sold the building 18 months ago at lower pricing, there's a lot of developments out there that aren't going to make it or aren't going to make any money.
Yeah, absolutely.
Despite 5-6 years of blood, sweat, and tears.
Yeah.
So I think it's important to kind of contextualize that. But
Yeah.
they get vilified, and obviously so does the real estate industry. And
Yeah.
people are looking for who to take it out on.
Yeah, it's true. I mean, I look at the builders and think to myself, well, like let's create a market environment that supports them, because I do believe this is a supply issue. And instead of capping, rental increases, instead of making it an onerous process to get approvals to build, get out of the way, let these people build, let them raise their rents as much as they want to. What'll end up happening is there'll be a flood of capital coming into the market, and it'll take care of itself. Like prices will and rents will go down because so many people will come going, oh, this is amazing. I can build in Vancouver. I can build quickly. I can raise my rents to whatever. I mean, temporarily or short term, it'll be painful for those who are living in a rental environment where they all of a sudden got to start raising their rents by 7 or 8% a year or 10% or whatever the person wants to raise them by. But if you also allow a flood of new supply, then it becomes a real free market. And as a renter, you can go, you know what? Sorry, pal, you've raised your rent too much. I got 3 other places I can choose from here.
You can only raise your rent so much as like the incomes can actually qualify to support them, right?
Yeah.
So it's like landlords don't just arbitrarily say, oh, I'm going to rent it out for, this 2-bedroom for $4,000 a month. Like someone's salary actually has to ultimately support that. So if you raise the rent too high, the tenant will just leave.
Yeah.
And someone else will have to come in and fill that vacancy. So yeah, I think if you let the free market take care of itself, I think ironically, when you study a lot of these other like housing markets, it's the markets that have the most sort of regulations and restrictions on rents, and that end up being actually the least affordable and have the most sort of issues.
Yeah, absolutely. You're absolutely true. It's like the opposite effect of what they're trying to achieve. Can you explain for our listeners what is a pre-sale, and talk about the risks associated with pre-sales? What does the pre-sale market look like now in 2023? There was a lot of, I know, funky activity going on with pre-sales. If we go back before this foreign homebuyer tax, where there was a lot of foreign money supposedly was coming in on these pre-sale sale. Like if we go back to like 2012, 13, 14, 15. So can you talk about, first of all, explain to listeners like what is a pre-sale, and what's your view on it today?
Yeah, pre-sales. I mean, it's essentially a futures contract, right? So you're buying a contract which gives you the rights to that unit. So when it is completed 3-4 years from now, you are able to close on it. So you lock into your contract purchase price today. And so the benefit is over the last 10, 15, 20 years, pre-sales have done really well because you've had a market that's continued to go up. So you buy a pre-sale and say, oh, I'm buying this 1-bedroom for $600,000 today. But the market goes up 8% a year, which is historically what it's done.
Amazing.
And in 4 years' time, that 600,000 is really worth 750,000 or whatever, and you flip it for a tidy profit. And that's been the game. And I think now we're at the point where the math is just really hard to sort of rationalize. So, for example, if you look in downtown Vancouver here, you haven't seen a developer launch a new pre-sale in the last 5 years below $1,700-$1,800 a square foot.
Wow.
And you can buy resale. You can buy a 5-year-old resale building of similar quality, similar type for about $1,300 a square foot, $1,350 a square foot. So you're paying a huge premium today to lock in. So I don't know necessarily what the upside is. Now at the top of the market here, we had the highest ever price per square foot was the Butterfly project at $3,000 a square foot. And that still is
amazing. That's West Bank, right?
West
That's
Bank.
up on
Berard and Nelson.
Nelson. Yeah. Yeah.
And that, is going to come for completion realistically probably in 18 months.
Yeah.
And I don't know, like
3,000 a square foot.
what does that appraise at? I don't know.
Yeah.
What's the bank willing to lend on that property? I don't know.
Yeah.
And I think people, when they sign into those contracts, mortgage rates were about 2.5%. Well, now they're at 5%. Again, I don't know where they're going to be in 18 months, but who's going to be able to qualify if they're at 5%?
So do you think we'll see some people in those pre-sales that have to just basically walk from that property, and whatever deposit they put down, they're just going to have to just walk away from?
I think if you look at a lot of these projects, some of them, some of the more expensive ones downtown, you can see on the MLS there's 20, 25, 30, 35 assignments on the market currently for sale.
Is there really?
An assignment basically is someone saying, hey, someone buy the contract.
Yeah.
I want to sell. I want out of this contract.
Yeah.
And so, I think there's a big question mark around who is going to be able to complete on these units. And I think there's a lot of people that have done well in pre-sales, and you have to be very selective on projects. Some will continue to do well. But I think, I don't know. I personally believe that the golden era of printing money on pre-sales
is,
I think it's very much up in the air.
Yeah.
I'll give you one more example. I had a friend of mine, let's put it that way. He, he says, in Brentwood, they've got the towers there. So he goes, I've got the friends and family discount. I work for the developer. They can offer it to me for $1,600 a square foot. And I said, well, that's pretty expensive. But he goes, well, Tower One, when they sold it 7 years ago, was about $600-700 a square foot. So if it can, if Tower One could do that, why can't Tower 4 or Tower 5?
Yeah.
And I said, well, I suppose if you continue to extrapolate, but at some point that's $1,600 a square foot. Time you tack on GST, property transfer tax, then you resell with your realtor fees, you need about $1,750, $1,800 a square foot to exit this thing.
Yeah.
So at some point, the math, I think, will start to break down.
Yeah.
But it's been...
And that was Tower 4?
Yeah, Tower 4, Tower 5.
Yeah.
I can't remember whatever tower.
The other part of the answer is, and there's also that. The first one was Tower 1. There were no other towers around.
Yeah.
Now there's 3 others to choose from.
Yeah. So it's, and again, if you look at the resale prices, they're about $1,200, $1,250 a square foot.
Right.
So it's a big premium.
Yeah.
You got to hope for a lot of things to go right.
Yeah. Let's go back to the mortgage data, because as we talked about earlier, there's a lot of homes in Metro Vancouver, especially in some of the wealthier neighborhoods, where there are no mortgages. But on the flip side, for those who do have mortgages, the latest data from CIBC states that 20% of mortgages in Canada are currently not even covering their interest costs. So it seems almost like we have like these two extremes. Like on one extreme, you have people who literally have, they have no debt at all, at least in the primary residence, and they've benefited from this amazing 20-year bull run. And on the other end, you've got people who got into the market more recently in the last 5 years or so, 10 years, probably 5 years. And they got into these, low rate mortgages at the time. Qualification was easier. And then and a lot of them are maybe in variable rate. And now like 20% of mortgages in Canada cannot cover their interest costs. What are your thoughts on that?
I think it's a real concern. I think the variable product in Canada, the way it was designed for most of these big banks, I think it's coming home to roost that maybe it wasn't a great product. Because I don't think a lot of people really understood it. To be honest, if you chatted with a lot of the brokers as these rates were going up, they didn't really know how the banks were going to deal with it. They didn't know how the trigger rate wasn't really, it was like a fine print item on your mortgage paperwork.
Yeah.
Nobody really understood it. And so nobody expected rates to go up again 400 basis points in 12 months. It was unfathomable.
Yeah.
I think what we're seeing now is that banks are essentially extending and pretending. They're basically allowing these people to, in a lot of cases, add the interest to the outstanding balance. So the balance is actually growing on the mortgage.
Yeah.
So the question mark is really what's going to happen when they come up for renewal.
Yeah.
What you're supposed to do is you're supposed to take the remaining term. So if you sign on a 30-year amortization and you come up after 5 years to renew, you're supposed to fit the remaining balance under 25 years, which means you're going to have one large balloon payment. So that's going to be a real concern for a lot of households. Now, I think what's going to happen, or what's probably going to have to happen, is the financial regulator, OSFI, is going to have to figure out a way to juggle this. And I think what's going to happen is realistically working with borrowers on an individual basis, or perhaps through policy change, to allow people to re-extend their amortization without having to requalify.
Right.
Because if you want to actually extend your amortization, you're supposed to requalify.
Yeah.
Which
and
means
those tests are there. You
got to get stress tested.
Yeah, and just to make sure it's clear. So that's the stress test is 2% above current
your contract rate. So if you say I'm going to renew next year at 4.5% mortgage rate, you got to stress test at 6.5.
6.5. Yeah, yeah.
So
of course that was all those, that policy was designed back when interest rates were at like 1.
Yeah,
yeah,
yeah.
You know, the other factor that these banks are having to face is that so you've got 2 types of mortgage borrowers, right? There's the variable rate mortgage borrowers, and then even within that, as I understand it works, is you've got the main banks, and when rates kept going up, their payments didn't change. They're just the allocation of how much went towards principal and interest changed. So more towards interest, less towards principal. Versus what they call B lenders, where those people had to immediately saw increases. A couple guys I play hockey with, one guy in particular, he's like, "Oh my God, Andrew! Every time they raise interest rates, by 0.5%, my mortgage payments go up by $500 every 2 weeks." Right now, the other pool, though, which is where historically the majority of mortgage borrowers have been since you and I, or before we were born, is the 5-year fixed term market. Now, every single month right now in 2023, there's people who locked into a 5-year mortgage in 2017 at like what, 2-3, maybe 3%, and at that time.
Yeah, UB 2018 coming up for renewals. So
2018, sorry.
2018, you had rates at about 3.5.
3.5, and now they're having to increase. They have to renew
about 5.
5.
Yeah.
And then wait until a year from now, assuming rates stay flat. I don't think they're going down. I think they'll probably go higher because of inflation. And I think we're just in a pause right now. And so you go a year from now into 2024, 2025, and in 2025, people who qualified for a mortgage at literally like 2%, and now they're having to renew at 5%. Like, that's a very painful move.
Yeah, it's gonna be a painful move. I think there was some commentary out from some of the banks yesterday saying they were seeing their sort of average renewal, average household was seeing about a $300 to $500 increase.
Yeah,
on their monthly payment. So perhaps manageable. I mean, I think that 300 to 500 is across the nation, right? So imagine someone in Vancouver or Toronto where house prices are higher, mortgages are higher, that payment is probably more than 300 to 500.
Yeah. It could be crippling for a lot of people.
Yeah. And I think that's ultimately going to pull from discretionary spending elsewhere, right? People will scrap together as much as they can to pay their mortgage first.
Of course, they always do. I mean, no one wants to give up their home, right? I mean, this friend of mine I play hockey with, he has a truck that he's got a loan on. He's got some snowmobiles he's got loans on, so he's getting rid of those. Maybe going to get even a roommate before he goes to sell his place. So,
that's why I was saying to you, like, the beginning earlier in the show, which was like what the conversations we're having with people, like a lot of these investors and stuff that have, multiple units. It's more about right now about cleaning up the balance sheet.
Yeah.
It's not about adding to the portfolio. And that's why we're not still seeing like, some of these like glitzy high-rise pre-sales, like they're still a tougher sell right now, because they are typically sold to investors, and the investors are still a little bit tepid, right? The numbers don't quite pencil, and people are trying to clean up their balance sheet, not necessarily add to the portfolio.
Yeah.
And so again, coming full circle, the demand that you're seeing today, the multiple offers and whatnot that you're reading about in the media headlines, is predominantly catered in the end user market, entry-level single-family houses, one bedrooms for first-time home buyers.
Steve, with respect to these banks' mortgages, one of the things I was bringing up on my phone here is their share prices. And I won't digress too much, but I think you might find this interesting. So, general rule of thumb, and this is my world, is that when interest rates go up, banks make more money. I mean, it's historically been a great investment play is to put your money into bank stocks when you're in a rising rate environment. And the simple reason is because how do banks make money? Well, if you're a depositor and you've got you're a rich guy with a bunch of money, and I'm this, guy who's I'm borrowing because I need to buy a house. Well, the banks will take your money and they'll pay you a rate of interest down here, and then they'll lend it to me and charge me a rate of interest up here. And that's the spread. And historically, the big Canadian banks, they're looking to make about 2.3%, 230 basis points spread between those two. And they have to obviously offset their books. So if they're issuing a lot of 5-year mortgages, that's why the 5-year fixed term GIC is the most popular bank product around and has been forever, because they have to match their liabilities with their assets. And for banks, their assets are their loans. When interest rates go up, they can immediately start charging their borrowers a higher rate right away. But there's a lag for the depositors. There's still a lot of depositors today, in my business that I run here every day, where there's clients of ours that we talk to, their banks are still paying them near zero when they should be getting close to 4 to 5% of their cash. So their spread widens. And so as a result, spread widens, bigger profit margins, share price reflects that. Now, here's the perplexing thing. If you look at the 1-year share price of Canada's 2 biggest banks, and a lot of people talk about the big 5 banks or big 6, and they go in order of this. So it's Royal's number 1, then TD, the Bank of Nova Scotia, BMO, CIBC, and the National Bank. And people say, oh, it's the big 6. And they think it's like they're all the same, but they're not. Like if you actually took the bottom 3, being National Bank, Bank of Montreal, and CIBC, those 3 bottom ones, if they all merged together, they would still, as a merged bank, still be smaller than TD or Royal. So TD and Royal are like monster banks. And so I always like to look at their share prices because they tend to be less affected by some anomaly in the market. And I don't like looking at BNS, even though they're number 3. BNS has been getting crushed. I mean, if I look at their 1-year share price, they're down 23% in the last 12 months. But they also have a huge amount of exposure to Latin America, right? And that's a whole emerging market that none of the other big 6 banks have exposure to. But if I look at Royal Bank, which is like the sort of premium name out there, right? Their share price is down 5% in the last year. And if I look at TD, who's actually bigger than Royal in assets, just slightly smaller in market cap, they're down 19.6%, but they're down 20% in the last year. Okay. I talked about Bank of Nova Scotia already. If you look at Bank of Montreal, just again, put some perspective, they're down 18% in the last year. And if you take a look at CIBC in the last year, they're down 22%. So in a rising rate environment, where bank share prices should be doing well, they're doing the exact opposite. So you ask yourself, why? Well, in my opinion, it's credit risk, right? That's what it is. And when I talk to the people that I know in the banking world, that's what they all talk about. It goes back to this question of like 20% of mortgages in Canada can't even cover the cost of interest. So what's going to be really interesting going into the remainder part of 2023, right now the financial markets are implying no more rate increases by the Bank of Canada, but no cuts as well. And I think what's going to be fascinating to watch is what happens is if inflation stays high, the Bank of Canada will be forced to raise interest rates. Otherwise, we get what happened in the 1970s and early 1980s. And that's going to be a real problem. Now, there's been a lot of stress on mortgage borrowers right now while they're gainfully employed. We also have historically the lowest unemployment rate ever seen in the country. If we start to get unemployment happening to tick up, it doesn't matter whether your payments went from $1,200 to $1,500. If you're not gainfully employed, you can't make either of those payments. Do you have any thoughts on where we may be going if we start to see rising unemployment?
I mean, I think that's like the big X factor.
Okay.
Right, the wild card.
Yeah.
You talk to anyone in the banking industry that's connected to these big banks, and that's what they'll tell you. That's like what they're most concerned about is rising unemployment. It becomes hard to service a mortgage. So right now, I think people are getting like essentially the extend and pretend with these. Hey, don't worry about paying all your interest. We'll just tack it to the balance, and we'll figure it out in 5 years.
Yeah.
Similar to the mortgage deferrals during the onset of the pandemic. Don't pay your mortgage for 6 months.
Yeah.
And thankfully, thankfully and unthankfully, we printed so much money and got everyone back to work that it kind of papered over the issue.
I think all it did is kick the can down the street, to be honest with you. I don't actually think it solved any problems.
We're seeing obviously the ramifications of those policies now through inflation and through rising interest rates, right? So
absolutely.
I think the unemployment
it's like having been diagnosed with cancer instead of treating it hard and fast, cut deep and cut hard and make it painful for everybody right at the beginning, you load the patient up with a bunch of like pain medication to make them feel like they don't have cancer, but they have cancer and you should cut it out. But we're not there now anyway. So
I mean, I totally agree. I think that, so that is like the X factor, is basically like, and I know this is kind of the ongoing dialogue in financial markets, right? Is like, is it when it's soft landing? Is it hard landing? Is it, right. People are saying no landing at one point, which is kind of the fairy tale.
Yeah.
So
where do you think we're going then? It's April of 2023. We're filming right now. Interest rates, I think everybody's buying in the idea that interest rates for the calendar year will just stay flat, not go down, not go up. You've mentioned this whole maybe move back towards just a shift back to something normal for the listings, that there's not a lot of inventory. But where do you think we're going to go? What do you think is going to happen?
I think it would be a fairy tale if highly levered Canadian households, we just printed a whole bunch of money, ran massive deficits, dropped rates to zero, papered over everything, and we got unscathed with an 8-month bear market in housing. And it was back to the races. To me, that's a fairy tale. Could it happen? I suppose. I think it still feels like a low probability event. I think in the very near term, the micro is going to play out, which is there's no inventory. And so you can't have price corrections without inventory. The X factor is going to be unemployment.
Yeah.
And I think if we get a deeper recession and more unemployment, then I think that this bear market is definitely not over.
Yeah.
So it's really going to come down to that is how hard is landing, and I think that's really going to play out in the macro, which is always hard to predict. But what's happening with these U.S. banks, the credit risk, 20% mortgage deferrals here, or mortgage outstanding interest payments, stuff of that nature. So I still think, and we tell all our clients this, like there's still risk out there.
Yeah.
Whatever you're buying, you'd be planning to buy something with an outlook of 8 to 10 years.
Yeah.
Not, hey,
that's really good advice.
Yeah, no, like go buy something you're going to live in and enjoy.
Yeah.
Because I don't know, like if you try to exit this thing in 12 months, 18 months, 36 months, I don't know where the market could be. Yeah. I think we're in a lot of volatility right now.
Yeah.
I think you can see that obviously in the bond market.
Yeah.
And we're seeing it, you chatted earlier about mortgage rates and what the banks are doing on their spreads.
Yeah.
I can tell you in the mortgage market, if you look at the Canada 5-year bond right now, today it's at about 2.8?
Yeah.
2.8%.
Yeah.
That is indicative of a mortgage rate that should be low 4s, very low 4s. And right now we're still got most banks at 4.9.
Yeah.
4.8, 4.9, 5.
Yeah.
And some of these banks aren't even competitive.
Right.
So I can tell you Scotiabank is trading mortgages 30, 40, 50 basis points above all their peers.
Wow.
And they were probably I would say, in my opinion, one of the more aggressive lenders during the pandemic.
Okay.
Especially to the investor pool.
Yeah.
And so they've completely pulled back, seemingly, from the mortgage market. So I still think there's a bit of a risk off.
Yeah.
From the bank's perspective.
Yeah.
They're not competing on rates right now. They're
saying, that's the banks telling you something, right?
Yeah.
Like they're telling you that we're not betting that rates are going to go lower here or stay low.
So during the pandemic, right, you'd go apply, you're going to go buy a house. You talk to 3 mortgage brokers. They get you one rate at RBC, one at BMO, and one at TD. And all 3 of them are going to compete on rate. They're saying, BMO gave you, 2.1. We can give you 1.9.
Right.
And everybody was competing. And today it's like, you got 4.8 at TD. Go with TD then.
Right.
We're good.
Yeah.
Our rate's 5.
Yeah.
So they're not really interested in competing, which I think is a little bit telling. And like I said, given where the 5-year bond yield is, which typically prices these mortgages, banks clearly aren't passing on those quote unquote savings to their clients right now on the mortgage side.
Yeah, I agree. This graph here I have, Steve, is the latest from it's up to the end of March, and it's the Real Estate Board of Greater Vancouver's price chart that goes all the way back to 1977. I should have pulled this for the early 80s just to show how bad this was from the peak in 1980, like the beginning of 81 till it didn't actually recover for like almost a decade. It doesn't look like on this graph, it doesn't look like much of a drop. But that's just because the reference price isn't based on today's dollars. But when I look at the tail end of that graph there, when I look at that as a guy who works in the financial markets and looks at charts all the time, to me, this is what we call a dead cat bounce. Right?
Yeah.
This is like just everybody's excited, prices are going back up, and then all of a sudden, boom, right? It's a
Yeah,
dead cat and just bounced off the ground. That's all it is.
and it could be like 2017, right? I mean, 2015 into 16 blow off top.
Right.
Yeah, and then we came back in spring of 17 and the market picked up again and people said, "Oh, people digested the foreign buyer tax. It didn't really work, didn't do a whole lot." And then again, we kind of rolled over later on in 2017 into the back half of 18 and we picked up ironically at the early onset of 2019 when the Fed started cutting rates again.
Yeah.
So yeah, I mean, that's kind of to my earlier point about pre-sales, right? I mean, you go back to the 1990s in Vancouver, for example, you had basically 10 years of no price growth. So, I mean, that's always a possibility. I'm not saying that's my base case, but it's something to consider if you're a pre-sale investor and whatnot, is like to extrapolate growth every year. It's possible that we go through a period of very low to no growth.
Yeah.
What's funny is run those charts. I know you're a monetarist.
Yeah.
Run Vancouver real estate prices priced in gold.
In gold, really?
Yeah, and they're down.
They're down?
Yeah, they're flat. They basically peaked, I think, in like 06 or something, and they're actually down. But I mean, it's a funny exercise because I think it kind of paints a picture of life.
Yeah.
And markets.
Yeah. Well, that's it. Yeah, I'll have to run that. I can run against Bitcoin as well. Let's talk for a moment as we start to wrap this up about housing policy. I had the pleasure of having Brendan and Trevor Coote, the CEO for BCREA, the BC Real Estate Association, who represent realtors like yourself across the province. And when they were in here, I guess probably about 6 months ago now, maybe, I asked them about policy, federal, provincial, municipal policies, any that you like, any that you don't like, and they were pretty candid about it. So I just want to ask you the same question, Steve. Like, obviously David Eby's been coming out with a lot of new concepts and ideas and policies. Are there any that you've seen recently? Any that you that you like, that you don't like? Are there policies you've heard about in other jurisdictions that we don't have here in BC or Vancouver, that you think government is doing a good job with, or are they getting in the way of having a more healthy real estate market?
I think the rent cap stuff in BC, I don't think we chatted about it. I don't think it makes a whole lot of sense. I think it actually, like I said, I think it discourages supply. Talk to a developer, try to run the numbers, and your costs are going up 7, 8, 9, 10% a year, and you can only raise rents 2%. You're not going to want to build and invest in more rental housing. Yeah. So I think that's a bad policy. I think the good policy, David Eby's, I think rezoning single family to allow multifamily, I think is going to play out, I think, really well. Yeah. I think the stress test was actually a good policy at the time when central banks were leaving rates at zero for a prolonged period of time. I think it was smart policy, and it was the policy. People get confused with it. I think the policy was actually designed to slow credit growth. Mm-hmm. It wasn't necessarily to like, oh, we're so worried about these borrowers. It was really, I think, to slow the pace of price appreciation and slow credit growth in the system. And so I think that was good policy at the time. The problem is with the stress test
do you still support it today, though, at such higher interest
I think rates? You could make an argument that it should probably be amended at this point.
Yeah. It kind of served its purpose, but
yeah, even if you dropped it from 2 to 1, like I think it should be like pro-cyclical, right? Yeah. And so, I think that's one. The problem with the stress test is basically what ended up happening was it was kind of like a snapshot in time. So the problem is basically you've got, little Joe, who's the first time home buyer, but he requires mom to co-sign on the loan. So you're not really stress testing Joe, you're stress testing Joe's mom.
Yeah, right.
So, and is she really going to step up to the plate if he starts missing his mortgage payments? So I think that was the problem with the stress test and how people were getting around it. Was basically everyone then had to get a co-signer
right
onto the mortgage.
Yeah.
Again, we'll see if that becomes an issue down the road.
Yeah. Yeah. What about thought on immigration? Do you think this is going to be a big factor? Because the Trudeau government historically has been very pro-immigration. We have a major labor shortage right now. So, we talked about rising unemployment, but that's not where we are. That's not a reality right now. In fact, we have like major like labor pool shortage going on. And now that the pandemic's over, because we had 2 years of virtually no immigration, we're expected to start to see roughly about 1 million people come into our country in the coming 2 years. What are your thoughts on immigration?
I think that it's worth having a healthy debate around.
Yeah.
I think that, we just had the most recent stats, which was 1 million people brought into the country in 2022. Now, keep in mind, the federal government targets permanent residency.
Yeah.
So they have, I think their target was 460,000 people last year, or maybe it was 430, one of the two numbers. But they don't really have a target for temporary workers and temporary foreign students. And
Right.
so basically you just end up opening the floodgates and they say, well, we're targeting these people, but oops, 1 million people came in and there's no housing plan. There's no plan because, as you know, getting projects and construction approved is basically done at the municipal level. And so you don't have these 3 levels of government communicating. The federal government just says, listen, we're going to open up the floodgates here. We're going to let all these people in and you guys figure out the housing situation.
Yeah.
And so we're already having issues, I think, housing our existing citizens here. We do have a housing crisis. And so I think it's a wise or a healthy debate to say, is the appropriate number of permanent residents, should it be 460,000 a year, or maybe it should be 360,000 a year for the next couple of years until we get our feet underneath us and we can figure out the housing situation, or, you can throw in any other infrastructure, healthcare, et cetera. So I think that's a healthy debate. The problem is, again, is you have 3 levels of very large bureaucratic governments, and a lot of them don't really, I don't think, have a plan in place. It's just everyone's pointing the fingers and saying, well, it's your problem.
Yeah.
And so nothing really is getting done, and this is the issue. And I think when you pull in 1 million people into the country, I think it papers over a lot of issues.
Yeah.
My favorite exercise is just to look at real GDP per capita, which has actually been declining since 2017.
Has it been?
So I don't. You could argue that, I guess, the Canada as a population hasn't necessarily improved, but
Right.
our GDP has gone up.
Yeah. In total terms, but not on a per capita basis.
Exactly.
Yeah. Yeah. Wow. Steve, you run a podcast, you've got a YouTube channel, and you've got lots of activity on social media. If people want to follow you, what's the name of your podcast? Yeah,
podcast is the Looney Hour.
Okay.
So it's myself and 2 other hosts, and
Yeah.
we're starting to get some guests on there. So
Yeah.
we're just trying to have basically a conversation like this, which is
it an audio podcast?
audio podcast.
Yeah.
We have it up on YouTube as well. So
Yeah.
we do throw both versions, but it's basically just trying to have a dialogue around Canada, the economy, macroeconomics, and financial markets, and basically trying to dissect how it impacts Canadians.
Yeah.
So I'll usually go on and chat about housing, and my other guests will chat about various markets and
Yeah.
currencies. And we're just trying to sort of enhance the conversation.
Okay, good. And you've also got a report that you publish, a newsletter of some type?
Yeah, so we do the Saretsky Report is a monthly newsletter. It goes out to a whole array of people. We've got policymakers on there, developers, we've got just retail people, but it's completely free. It's on Substack. So if you search Steve Saretsky Substack, it will show up, and it's predominantly about Canadian housing.
Okay. And then social media, you're on Instagram, LinkedIn,
Twitter,
Facebook,
very active on Twitter.
Yeah, you got a lot of followers on Twitter.
That's a full-time job.
Is it?
Yeah.
Yeah.
No, I enjoy
What's
the
your
debate.
handle on there? It's just
at Steve Saretsky.
At Steve
keep
Saretsky.
it simple.
Yeah, keep it
Yeah.
simple. Yeah. Well, this has been really great, Steve, coming onto our show today. Definitely would love to have you back another time to kind of revisit, where things did end up going from where we are here in early April of 2023. And keep going, man. I love the material you put out. I follow it actively, and I really appreciate coming on to Coastal Front today. Steve Saretsky, thanks for being on the show.
Thanks for having me on. It was fun.
Yeah.